Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com examines the bumpy declining markets, including where crude is positioned. Wolfstreet.com's Wolf Richter delves into what's behind the moves on the stock market, interest rates, and the real estate markets. Ed Steer from Ed Steer Gold and Silver digs into the precious metals market and into why gold and silver haven't taken off even with a decline in the equity markets. Plus, at the end of the show, we'll have company showcases from American Manganese President Larry Reaugh and Grande Portage CEO Ian Klassen. We'll talk to Ross Clark right after this.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink's CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
AMY.V Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the Pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, AMY.V's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at AMYresources.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. Welcome back to the show, Ross.
Good to be with you, Jim.
Boy, an interesting day to be watching the stock markets.
An interesting week or two. My gosh, here we were around the 10th or the 11th of the month, starting to slide a little bit, getting first oversold readings, and you bounce for a day and a half, just falter at the lowest possible resistance level, get another bout of selling, and by the time we get into Thursday and Friday, I'm getting capitulation readings as far as the most of the broad indices are concerned. I haven't had one in the Dow in a couple of years now, but we've got one to finish off the week. So it's continuing to mimic these broad consolidations that we saw after major moves, like the rally from 2003 to 2007, the rally from the mid-90s to 2000. You go back to the even bigger one in the 1950s, from 1949 to 1959. You have the same market advance percentage-wise that we've seen as far as this rally is concerned since 2009, and the same type of consolidation phase. Now, whether this becomes an ultimate top, that story is yet to be told, but the unwinding or process of all the excesses is happening very, very similarly. So we've got capitulation at this point by our definition, and it's probably not the bottom. We would expect that you've got a chance for another reasonable bounce like we did around the 11th or 12th of the month. But market's going to have to prove itself. We haven't got down to the long-term moving averages. That in the Dow is still a good 1,000, 1,500 points away. And the S&P pretty much has to go down below that February low before it gets really interesting. So if we can break down in there, then show some signs of stability, might be a chance for a year-end rally. But I think that for now, it's still sell the bounce time.
What's happening with gold?
Well, as we pointed out, when you get a 5% move in the equity markets within a 2-week time span, you get a bid in the gold market. And that happened on the first sell-off that we had in equities at the early part of the month. Gold ended up with that nice move, got up to about 1235, then paused as the stock market paused. And then we've had this second series of selling in stocks, you've had the second bid come in on gold, got up over the 1240 level. This is now, we're 10 weeks off the bottom. And bear market rallies in gold tend to be 9 to 12 weeks. So this one's getting a little long in the tooth if this is still the bear market. The key resistance levels are up at the 1255 to 1260 level, and I think as long as this rally is capped at that point, then I'm still looking at the first week with a lower low as being the catalyst for a fairly significant break. And the miners, we take a look at what's happened to the GDX, the Huey, the XAU indices. They just did not participate very well during this last week, and most of them got really pummeled. So you'd want to see if there's strength in that market, in that sector. You'd want to see the miners participating with the bullion. You'd want to see silver moving along as well. We're just not seeing that right now. So as far as I'm concerned, the jury is still out as far as whether a final bottom was in place from the summer. There were some decent signals down there for interim rally, but that interim rally, I think right now, might be a little long in the tooth.
And we'll dig deeper into gold with Ed Steer a little later in the program. Ross, on crude oil, are we getting any big movement there?
Well, we're having the action we were hoping for. The failure to break out at 76 and then sliding through what had been the previous support areas. We're now solidly under $70. This, as far as we're concerned, the seasonal and the 10-year cycle and everything still point towards something in the lower $60 range. Could easily be underneath that. And with the erosion that we've seen, I mean, it's been pretty quick. We've been, 2.5 weeks. We've dropped $10 here. So probably get a short-term bounce, but we, from our perspective, still want to see some lower numbers before you set up for the next leg in the rising trend. And this is a rising trend we've had for the better part now of, from 2016, first quarter of 2016, it's been a pretty good run. But this correction, ideally, as I say, more towards closer to $60 than we've seen. And as long as the rallies stay under 70, I think that will continue to be our modus operandi.
Ross, thank you so much for chatting with us.
Nice to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Coming up, Wolf Richter next on This Week in Money.
Always consult your investment professional before making any investment decision.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp, MGI and the TSX Venture Exchange. A 2015 drill program on the LH property intersected several high-grade gold intersections, including 11 meters of 20.66 grams per ton gold. Additional drill targets on the LH property have been identified by a 2018 drone airborne magnetic survey to further evaluate a peritite enriched gold-bearing system. Please visit our website at magnumgoldcorp.com.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Wolf Richter, publisher of wolfstreet.com. He's speaking to us from San Francisco. Welcome back to the show, Wolf.
Thanks for having me back, Jim.
The stock markets now, one of our analysts has called it a financial storm. It's not a coming one. That's how he described it, where you have 2 or 3 days of going down rather violently, then you bounce back up again. What's your take on the stock markets?
That's probably a pretty good description. Over the medium and longer term, there's a lot of stuff going on beneath the surface. where the stocks, the companies, everything combined is just starting to deteriorate. And in terms of the stocks, you don't really see that in the market indices in the United States. For example, the Nasdaq's down 10% today, even after its huge jump. But the other indices are down only in the single digits, so it's really mild on the surface. But you look underneath it, and for example, the banks, the big banks in the United States are down 17%. The home builders, they plunged 36% so far this year. The building and construction stocks, they're down 30%. The Russell 2000 small caps, which tracks all the smaller companies, the thousands of them, it's down 13% even after Thursday's really big surge. So you look at all these different segments, and many of them have gotten hit very hard. Yet there are some big companies, particularly Apple, which is with a market capitalization of $1 trillion, is the largest company we have, and it's not down very much at all. So it covers up a lot of just a few large companies. It cover up a lot of the turmoil going on beneath the surface. And that's not in the United States. It's actually one of the better faring stock markets. Still, once you go to another continent, in Europe, the banking stocks are down 25% from the peak this year. In Spain, the banks are down 40%. Overall, European stocks are down quite a bit. The MSCI World Stock Index, which tracks all the stocks in the world, it's down over 10%. So it's kind of a global move that is now moving toward the core. The global stocks have been down for a while. Now it's moving toward the core. The quality, we're seeing some of the better companies now starting to get hit with this. So, I checked on the New York Stock Exchange. There's over 2,000 listed stocks, and 175 of them were down over 50%. And that's from their 52-week highs. So from their highs of the last 12 months, they have plunged 50% or more. That's a big plunge, and that number will expand. So as we go through, there will be more and more of these stocks that will be down 50% or more, and that will eventually show up in the indices. I mean, there's thousands of stocks, but when you have one company that's worth $1 trillion and you got a few other companies that are worth close to $1 trillion, and there are 7 companies that are worth $4 trillion, that form a large part of the stock market. It's really the turmoil among the smaller stocks doesn't come to the surface until the big ones crater. And outside of Facebook, and Amazon, Facebook particularly, Amazon and Google have sold off quite a bit. Outside of those, it really hasn't happened yet. And Microsoft very strong, Apple very strong now. So these two companies alone can carry the stock market for quite a while. But the turmoil underneath the surface is what will come to the surface, and it always does. And it will impact more and more stocks. So we will, I think, what we will be seeing is a long series of sell-offs followed by bounces, and the overall bias will likely be negative. And the stocks are so overvalued, and interest rates are rising, and stock markets have been in denial of the rising interest rates for a long time, but now they're starting to react to it. And so this combination is going to have a big impact. And once the psychology changes of stock market investors, it will deteriorate further. The fear of missing out has driven the so-called the FOMO, the fear of missing out has driven much of the recent stock market surge. The election of Trump, has caused a huge bounce. In some categories, for example, in the home builders, and the building and construction companies, they have surged hugely just before the election, and then the year after the election, and they have now completely cratered. And they were hoping for some kind of infrastructure package. Yeah, this has happened in many other categories. So there was a Trump bump or a true bump. Yeah, it goes up on one side and then it comes down on the other side. And it's very well defined in many of these categories. And it's just hitting one category after another. And we're going to have a rough road ahead of us.
Do you feel it's possible now to have an infrastructure program with all these steel tariffs dramatically driving up the cost of construction materials?
No, it's not happening yet. Companies are complaining about it, but there's so many exemptions, and steel costs are not a huge. There's some buildings maybe where steel is a big part, like a steel building, steel would be a big part of the expense. But in many other construction projects like highways and so forth, you don't have all that much steel involved in terms of the cost. So, there's a lot of other expenses involved that are far greater. Now, a high-rise building made out of steel, that's a big part. But in terms of infrastructure projects, putting down a 6-line highway, that involves steel, but it's a relatively small part of the overall cost. So I don't think that has a lot of impact. Now, when costs rise like this, it's a margin squeeze for companies. And the competitive environment decides what they can charge. So the companies have gotten a huge tax cut from Trump. So they're not passing the tax cut on either. When the tariffs hit those companies, that is like a tax increase. And it's a tax increase on their profit margins, on their gross profit margins. So because their costs go up, and so that acts that way, and they're unlikely to be able to pass that on either. I mean, they didn't pass on the tax cut. They're not going to be able very easily to pass on the tax increase, because prices are set by a competitive environment. And, there's still suppliers in the United States. They don't have to raise the prices if they don't want to. If they want to get that extra business, they can. And, so this is being played out in a competitive market where when costs rise, margins get squeezed, but the prices don't necessarily go up. So I don't expect these tariffs, and there's so much to do about it in the media, but it's not really, and every company's complaining about it, but you're looking at their profit margins and they're still looking okay. And so there's just a lot to do around it. And at the same time, I don't actually see the impact. And the Fed is, concurring with that. They're watching. Doesn't that keep saying after every meeting, we don't yet see the impact of any tariffs. It's just not showing up in inflation, and it's not showing up in a lot of those things. There's a lot of complaining, a lot of, moaning and groaning going on about that. But, in terms of actual impact, we just really haven't seen much of it. So I don't think this will have an impact on construction, but there's a much bigger problem with our construction infrastructure projects, actually. Yeah, I mean, that's really what we're talking about. It's just not happening in Congress. There is no infrastructure package and of any size to speak of. It just hasn't happened. And, instead we got a big tax cut. And, that deal is off the table, and it's not happening. We need infrastructure spending in the United States. The roads are terrible. The rail services are terrible. Our airports are ancient, most of them. And you go to a third world country and you look at the gleaming high-speed trains and the airports, you get all kinds of envy there. And when you come back home, so it would have helped to have a big infrastructure package, but that's not happening. And so that's what we see in the stock market. The infrastructure companies that have surged with the hopes of getting this package, they have now plunged. They're back to normal and to where they were in 2016 and before. And so that bubble has completely gone.
We'll have more with Wolf Richter when This Week in Money returns.
I'm Kelly Jennings, CEO of PowerBand Solutions. PowerBand is a cloud-based provider of auction, inventory, and finance solutions that make buying, selling, and financing vehicles more efficient. Powerband Solutions trades on the TSX Venture Exchange symbol PBX and on the OTCQB symbol PWWBF and on Frankfurt symbol 1ZV. For more information, please visit us at powerbandsolutions.com.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Wolf Richter. Wolf, what do you think is going to happen with interest rates and what kind of an impact are they having on business?
The interesting thing about interest rates is that the Fed was the first major central bank to raise interest rates, and they started in December 2015, and then we had the energy bust that was starting to take down a whole bunch of companies, and credit was freezing up in the energy market, so they stopped raising rates, and then the next rate increase came in December 2016, and then from that point on, they raised regularly, like clockwork. And over the years, the markets and the pundits have completely written that off. Initially they said the Fed will never be able to raise rates because it painted itself into a corner with its zero interest rate policy. It will never be able to raise rates, and it will never be able to get rid of QE. So, the Fed is now doing both, getting rid of QE and raising rates. And gradually, very gradually, the markets are coming to grips with, the fact that this is actually going on. And the Fed has continued to say that even the doves in the Fed have said that interest rate increases going forward are the right thing to do. And it has pointed at asset price inflation in many ways, not at consumer price inflation. And asset price inflation is a risk for the banks, because they use these assets as collateral. And the Fed has pointed out many times one particular asset class called commercial real estate, and that's in the United States. That's a $4 trillion, it's backed by $4 trillion in loans, and half of those loans are at banks, and the other half is spread around among non-banks and government entities and so forth. And now everybody is warning about commercial real estate being in a complete bubble. Commercial real estate that includes apartment buildings and industrial buildings, warehouses, and those kinds of things. And the cap rates and the profit margins that commercial real estate investors make are at record lows because prices are so high. And the Fed has been raising rates specifically to tamp down on those kinds of excesses. So now investors can choose between a 7-year Treasury maturity that yields 3%, a 10-year yields closer to 3.2%, and a commercial real estate project that might yield 4 or 5%. And there are huge risks involved in commercial real estate and almost no risks involved in treasuries. And so, there's starting to be, second thoughts about chasing, every commercial real estate project in the business because of that. It's finally happening, so after 2 years of rising rates, we're finally seeing the first little ripples going through the commercial real estate market. And this was one of the primary targets the Fed was going after. So the Fed's results are still very weak. It's wanting to tighten financial conditions. Financial conditions have not really tightened yet. The junk bond yields are still very low. There's still a lot of yield chasing going on. So the Fed is looking at that, and it's specifically targeting those things. So interest rates will continue to go up, and other central banks are following. The Bank of Canada followed this week with another rate hike. The central bank in Europe, the ECB, has promised to end its QE in December, and is probably starting to hike rates next year. The Bank of Japan has backed off on its QE efforts as well. So, a lot of other central banks smaller central banks are starting to hike rates. So I think there's a general recognition that it's not really about consumer price inflation, but it's really about inflated asset prices and the risks they pose to the financial system. And European banks are very weak. They're badly capitalized. They're very, vulnerable to asset shocks at this point. U.S. banks have recapitalized fairly well on the backs of savers that have gotten nothing on their deposits. There's $9 trillion in savings products at the U.S. banks that have earned practically nothing for a decade. So that has recapitalized the banks. So they're much better shape to handle that kind of thing. And the Fed's looking at that. They're thinking, okay, so what can the banks withstand? And this will continue now. So right now, the Fed is looking at neutral level, neutral being where it neither stimulates the economy nor where it slows the economy. And they're thinking that's around 3%. So they've got 4 more rate hikes approximately to get there, and then maybe a couple more rate hikes to tighten it a little bit, and then they're just kind of back to normal. That's what they have to do, to just go back to normal. We've been under, emergency rules, so to speak, for a decade, where these emergency measures of zero interest rate policy and QE have been maintained for a decade, and now it's really hard to get back to some kind of quote unquote normalcy. And the Fed is certainly trying to do this, and the Bank of Canada will follow and has been following. So on a fairly tight basis. So at least next year, I think we will continue to see more rate hikes. Now, something big might break, and the central banks may eventually back off. But a stock market sell-off of 20% is not big. That is nothing. These things happen. They're supposed to happen, especially after these big surges we've had. I don't think the Fed will get cold feet at 20%. I don't even think you will get cold feet at 30%. When credit freezes up, that's when the Fed gets nervous. So when companies that are profitable and that are well capitalized, that suddenly can't borrow money anymore, that's a problem for the Fed. And that happened during the financial crisis, but that doesn't happen often. So credit freezing up in a credit-dependent economy brings the economy to a halt. That's the one thing where the Fed will put out, and every other central bank too, will pull out all stops. Credit freezing up is just devastating to a credit-dependent economy. But a decline in real estate or a decline in stock prices is actually being targeted. I mean, that's what they want. That's what they're trying to accomplish. So it's not going to get them to stop or to back off. So I think next year we will continue to see those rate hikes, and maybe beyond that.
Wolf, a survey in Canada found a third of Canadians are worried about going bankrupt if interest rates continue to rise. Do you have that same kind of feeling in the U.S.?
Well, the U.S. and Canada the housing markets are structured very differently. The dominant mortgage in the United States is a 30-year fixed rate, where interest rates do not change no matter what happens for 30 years. And in Canada, you have adjustable rate mortgages and variable rate mortgages that dominate, and those interest rates do change. So for Canadians, rising interest rates mean that the house that they bought 5 years ago or 10 years ago can get more expensive. And that's not the case in the United States. In the United States, it's the new buyers that can't afford a home anymore because suddenly they're looking at high interest rates. That's the problem in Canada too. But in Canada, it's the existing homeowners that are having to deal with adjustable rate mortgages. So I think the Canadian consumers are much more vulnerable to interest rate hikes than American consumers in that sense. And the Bank of Canada has pointed that out. You know, they're very aware of that. I don't think that somebody who bought a home 10 years ago made mortgage payments regularly, you know, and didn't take out a second mortgage or borrow money against it. They're not going to be at risk. You know, there's a lot of people that paid off the homes. They're not at risk either. It's the people who bought the homes in, you know, the last 3 or 4 years, especially over the last 2 years, you know, and they're really going back 3 or 4 years, maybe 5 years to some extent. You know, those are the vulnerable people. Those are the people that have no equity in their homes, or very little equity when the prices come down. And then when rates go up, they're in a very difficult spot, because if they cannot afford the mortgage payment, and they no longer have any equity in it, it's very difficult for them to sell the house. If they have negative equity in the house and they can't sell the home and they can't afford the mortgage, you know, they're really stuck. Whereas somebody who bought the home 10 years ago and has a lot of equity, if they can't afford the payment, you know, they can always sell the house and walk away with some money and do something else with it. You know, so they're really not at risk. At risk are the recent purchases, and it's not 30%. You know, they're 30% of Canadians, a little over a third, you know, own their own homes outright. They don't owe any money on it, so they're not at risk. Another 30% have lots of equity, and they're not at risk. It's the bottom third, and of them, half maybe are at risk, and that's, you know, that's what you get with a housing bubble. You know, you have a housing bubble for 20 years, you know, and there's a price to pay, and the question is who's going to pay the price. And, you know, when there's enough defaults happening at the same time, the banks have trouble collecting on them. That was the case in the United States, and they essentially allow a lot of homeowners just to do what they can and let them off the hook. And I imagine some of that's going to happen in Canada. You know, the banks are eventually going to get drawn into this. And, you know, this will be gradual and very slow. So, unless there's some kind of big crash going on, you know, this is something that will stretch out over the years. So it'll be quite manageable unless something big breaks. You know, if you have enough time, if an economy has enough time to deal with this, it'll work its way through, and and consumers will struggle. You know, if you bought a home at the peak of the market and rates go up, I mean, that's life, you know. I mean, that was predictable, and it happened, and it's tough. You know, the bank's on the hook too, so they shouldn't have lent the money at these prices, but they did, and they were eager to do that, and lending standards were pretty weak, and so you know, that's an adjustment the economy will have to go through. I don't know that I share the fear of 30% of Canadians going bankrupt. I think that is a big number. I don't see that as realistic, but bankruptcies will definitely rise.
We'll have more with Wolf Richter when This Week in Money comes back.
Vatic Ventures Corp. is a potash exploration company focused on the Korat Basin in Thailand, the world's largest undeveloped potash resource. Vatic's management has extensive potash exploration and development experience in Thailand. Vatic will have marketing advantage compared to Western producers. Drill program commences this spring. Vatic trades on the TSX Venture, symbol VCV, and on Frankfurt, symbol V8V2. Visit our website, vaticventures.com.
Grand Portage Resources recently completed the 2018 drill program on its 100% controlled Herbert Gold Discovery property located in the prolific Juneau Belt in southeast Alaska. Drill results are expected through late 2018. Past drill results included numerous multi-ounce gold assays on multiple veins. Grand Portage trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Wolf Richter. Wolf, what's the state of the U.S. housing market?
Well, it's finally happening here in that there's plenty of demand, and there's now a surge of supply coming on the market, and yet sales are dropping off. And sales are dropping off of existing homes, so of homes that are sold by a homeowner, and they've plunged in terms of new homes, so homes sold by home builders. And we just talked about the home builder stocks, and that's why they're down. New home sales in September plunged 18% from a year ago. There's plenty. There are people looking at buying homes, and so houses or condos, and there's plenty of supply, but the price is wrong, and the sellers are having trouble adjusting to this new reality. So the prices are not coming down, and the buyers are going on strike. They're saying, I'm not buying at these prices. So, and it's all, after years of price increases, these are very expensive properties for a lot of people, and interest rates are going up, so it's getting a lot more expensive to finance them. And volume will continue to deteriorate until prices come down. And so right now we're in that stage where there's this sort of it's a buyer's market, but the sellers are not responding to it. The sellers are not cutting their price. They're still try to reach these aspirational prices, and it's just so the deals are not getting made. And in some cities it's worse than in others. In some cities, there's a lot of supply coming on the market and not a lot of demand. And prices still haven't come down in those cities a lot, and just barely. Yeah, but people just hang on to the properties that say, I'm going to rent it out for 5 years and wait till the market turns around. Now, 5 years from now, they may be worse off than today, but that's the hope that they'll find somebody to rent it or whatever. And I hear that quite a bit. They're trying to sell a property and they can't for what they want, and so they say, I'm just going to turn into a landlord, and I rent it out. And the rents are starting to hit limits too, so it might be difficult to make that equation work. So market after market, we're seeing supply increase, we're seeing demand, but for lower priced properties, the demand's not there. If sellers don't come off from their prices, and deals are not getting made, and that's showing up in just about all the statistics now, that the sales are declining, supply is rising, and the market is just slowing down, and there's a dance going on between sellers and buyers, and the sellers just don't want to come off, and until that changes, there's the volume. It's going to be hard to sell a home, and if you price the home properly, you come off enough, you'll sell it pretty quickly. But if you have some kind of crazy idea in mind that you want to get, it's going to sit on the market, and eventually you'll have to pull it because you won't be able to sell it.
Is Chicago going to be the first city to crack? Because I hear people are abandoning the place because their property taxes are skyrocketing to make up for the state's monstrous deficit.
Yeah, Chicago is kind of unique in that it's a huge city and really a vibrant city, and in many ways a beautiful city. But since about 2014, it has been losing population. And I don't think of any other major city in the United States where that is going on right now. They're all growing in leaps and bounds. So in Chicago, there are, Chicago is is sort of traipsing toward bankruptcy, and the city of Chicago, and it's trying to avoid that by making it much more expensive to live there, and people are not moving to Chicago as quickly as they should to make up for the ones that are leaving. And so you have this population decline going on, multi-year population decline. It's fairly minor. It's not huge numbers, but it's starting to add up. At the same time, you have a lot of new construction too. So their rents have plunged in Chicago. They're going to have a real estate problem there based on the dynamics of the population movement. And it doesn't help to make it more expensive to live there. At the same time, the option of going bankrupt, that would be curative. I mean, Detroit went bankrupt and the bankruptcy allowed it to shed some debts and some obligations, and it started to revive some since then. That would be helpful for Chicago too. Bondholders don't like that. Municipal bondholders are sacred in the United States. You don't ever want to just stick them with a loss. But the cities in California that have gone bankrupt, have done pretty well after bankruptcy. There's 4 of them. And so this is a relief for the cities. It may not be a relief depending on the rules and regulations in that state, whether pension beneficiaries can be made to suffer. In California, that's not really possible, so it was mostly bondholders. But in Detroit, there's a lot of pension beneficiaries that got hit. But the city itself, when it shut the debts, will revive, and if Chicago could do that, that would be a good thing. And bondholders should learn to take the losses, and Chicago should just pull the ripcord on it and get rid of its debts, and try to manage the city a little bit better. At the same time, until they do that, I think, the economy the economy in Chicago is pretty good. It's just, when you have a declining population, it's really tough to make things work, especially if you're strung out, fiscally, like Chicago is.
Any other areas in the U.S. that look like they might be a little shaky?
Well, I live in San Francisco, in the Bay Area, so I keep my eyes very closely on that. And what we have seen here is very strong demand and price increases until earlier this year, and it's sort of backed off now. And I just published a bunch of data and charts on just how tightly housing in San Francisco, housing and office rents too, in San Francisco and in Silicon Valley are correlated to the NASDAQ. So long as the NASDAQ has surged, the real estate is doing really well in the Bay Area. But a major sell-off, we're not talking about a 10% sell-off like we have right now, but a 30 or 40% sell-off in the NASDAQ, will, create some major reactions in real estate, in San Francisco. And let's remember after the dot-com bubble, the NASDAQ lost 78%. So that's a huge drop, 78% for an entire, stock index. So, I don't know that it will go that far down this time, but we're primed here for something to happen, because everything is just, it's just based on all this money coming in from IPOs and from stock-based compensation and from these high salaries that are being paid by the big companies and then by the thousands of startups that are being funded with lots of money here. So this is the whole cycle, and that can turn very quickly, and then suddenly these non-profitable cash burning companies are starting to lay off people. They can't afford to live here, so they leave. That usually happens. San Francisco empties out. People leave. Without a job, you can't live here. And they go back home or wherever they came from, and suddenly you have lots of vacancies. You have homes on the market. You have apartments that are vacant. You have companies that are shutting down, and that this is a cycle we go through every few years. And so everybody who's in real estate in San Francisco has been through the last two cycles. We're all expecting this. You know, this is in the cards. We don't know whether it's already starting to happen or whether it'll happen a little later, but this has to come. It's inevitable, and we're nervously looking at the Nasdaq now. It's down 10%, so you know, that's not going to really kill real estate here. But if it goes down a whole lot more, then with a 2 or 3 months, or 4 months, or 6 month lag, we'll see the results in real estate for sure.
Wolf, the auto sector, how's it hanging out? And were the companies that decided that 8 and 9 year loans were the way to go, is this going to burn them in the end?
Yeah, those 84-month loans are very tough on the auto sector right now, because it essentially forces people to hang on to their cars for a very, very long time. They can't sell because they're upside down in their vehicles. They have negative equity. At the same time, overall demand for cars is down. It's down in the U.S. It's for 2 years in a row now. So this is the second year. In Canada, this is the first year that it is down slightly. So the car business is cyclical. The last few years has been very good. So now that demand has been sated, and the automakers are getting hit very hard. The stocks are getting hit very hard this year. All of them, and except for maybe Tesla, but all the others are seriously being damaged this year. And this is. And U.S. automakers are global automakers. So, they're exposed to China. GM sells more cars in China than the United States. And China's auto sales just started plunging this summer. So, and it just started in June, and it got worse in July, and it got much worse in August, and it was really bad in September. And we don't know where that's going, but that is a development that is very tough for all global automakers. And China is the largest auto market in the world, so what happens in China is going to impact them enormously. So that's why the automaker stocks are really in a lot of pain right now. And Ford was trading at $8 a share the other day, and it's come up a little bit, but it's like 50% off, So it's really it's a beaten up sector, but it's still, we're very close to record sales levels. It's not like the auto sales have collapsed. They've come down a little bit off record levels. So there's a long ways to go in that pain. It's just been very good for so many years, and now that sales are backing off. And the economy is still very strong in the United States. It's as strong as it's been. It's in very good shape. And even though auto sales are backing off a little bit, we've seen suddenly we've seen some issues in auto sales in Europe too, and in September, so it's not exactly for the big automakers. It's not exactly a great place to be, and it has nothing to do with tariffs or anything. It's just consumers not buying as many cars as they did a year ago, and it comes down to consumers, and they have cars. They don't need any more cars. Their car's in great shape. It's 10 years old, but it's still fine. Why buy a new one? And there's a lot of dynamics coming together, and the long-term loans is one particular issue there. During the last few years, a lot of people financed their cars very long-term loans, so now they can't get out of them. They're stuck in them because they have negative equity in those cars. I think automakers will be in a world of hurt for the next few years.
How can people learn more about Wolf Street, and just a little thumbnail about your company?
Yeah, wolfstreet.com is free to everybody. It's a site that focuses exclusively on business, economics, and finance. We're a data-driven site, so a lot of nice charts, and we also have a vibrant discussion section where we talk about the issues that are going on in the articles. And so come see us at wolfstreet.com.
Wolf, thank you so much for chatting with us.
Thank you, Jim.
My guest has been Wolf Richter, publisher of wolfstreet.com. He was speaking to us from San Francisco. Coming up, Ed Steer next on This Week in Money.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2 AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and Canada. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol AESDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Ed Steer, founder of EdSteerGoldandSilver.com and a director of GATA, the Gold Antitrust Action Committee. He's speaking to us from Merritt, British Columbia. Ed, welcome back to This Week in Money.
Always a pleasure to be on your show, Jim.
Ed, does it look like the bottom is in now for gold and silver?
Well, you would think so. It probably came a little while ago, so one would think so for this particular move down, that we've seen the bottom for a while. We won't revisit this low again anytime soon, if ever.
Gold and silver recently had a bit of a pop in price. Is this likely the beginning of a move higher?
Well, one would think so, and I know that the Commitment of Traders report certainly indicates that we're going to see higher prices as the short positions of the managed money traders get unwound. But it's also equally obvious that they're not allowing the price to go too high. The powers that be aren't letting the price go too high. It's Friday morning as we do this interview, and you can see that prices popped in New York this morning, but they weren't allowed to get far. But is this the beginning of a move up? Yes, it is, but how high and how long it will be allowed to last, I don't know.
Could we see a paper gold and silver short squeeze?
Oh, well, certainly that's been the case for a while now. As I just alluded to, the short positions of the managed money traders in gold and silver particularly, are almost at record levels. And if the powers that be decided, they could just put their hands in their pockets and not go short this next rally. And we would see precious metal prices over the moon in very short order. Whether that's going to happen or not, I don't know, but the potential is certainly there.
Is COMEX silver in demand? And for people who are new to the show, what is COMEX silver?
COMEX silver, there are 6 large COMEX depositories where silver and gold and all the precious metals are held in New York. J.P. Morgan's got one, Scotiabank, Brinks, HSBC, CNT. Those are the major depositories within the commodity exchange that are registered warehouses. Silver analyst Ted Butler has been following the shenanigans in silver in particular, which is the one of interest to most listeners. And since J.P. Morgan bombed the silver price back on, I think it was May the 1st, 2011, they've been pouring silver into their warehouse the COMEX warehouse in New York, and they now have a record level amount there. And it just keeps on coming and coming. It's amazing to watch the demand that J.P. Morgan, insatiable demand J.P. Morgan appears to have for silver.
The various markets in China are in trouble. Are the people of China likely to buy gold and silver for safety? And if they do, what would that do to the market?
Well, it's like any other country. The Chinese have more affinity for gold than we here in the Western world do. one would think that that's what they would do. Their markets are in trouble right now. We haven't seen any real jump in demand per se that we can identify. But if the Chinese ever get it into their heads collectively to go for the gold, as they say, well, there wouldn't be enough gold mined this year or the next 10 years to satisfy whatever possible demand. The potential is there, just like there's a potential for everything else. But will it come to fruition? I don't know, but if it does, look out above.
Could other events cause gold and silver to pop higher?
Oh, sure. I mean, the world is full of black swans right now, whether they're political or financial or economic, and they all seem to be coming to a head at this point in time. They're getting closer and closer together. You could have a currency crisis, a dollar crisis, a renminbi crisis, whatever you want to say. The economic crisis is basically already here in the U.S. and in Europe. A monetary crisis on top of that would just put the icing on the cake. So there's a huge number of factors that could be pointed to if that would allow precious metal prices to soar. And just pick your favorite one, but I get a feeling that when this thing finally does go, it will be a confluence. It'll be a large number of events happening simultaneously that will set it off.
We'll have more with Ed Steer when This Week in Money returns.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineered gold mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE symbol CRL and the pink symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking with Ed Steer. Ed, we hear a number of countries now are selling off their U.S. treasuries and buying gold. If that's true, why isn't the price of gold going higher?
Well, there certainly are more countries and central banks purchasing gold. That has been in the news lately quite a bit. The reason it hasn't affected the price of precious metals, gold in particular in this case, is the same reason I give all the time, is the fact that JP Morgan and maybe one other bank or two are sitting on the price in the COMEX futures market, because the price is not determined by supply and demand. It has 100% to do with the paper positioning in the COMEX futures market between the commercial traders, which is just a euphemism for JP Morgan and maybe Citigroup, and the brain-dead managed money traders who are trading other people's money. And it's the tango between those two that sets the price. This is something that silver analyst Ted Butler's been going on about now for the last 10 years, and more commentators are now talking about it. But until the paper price is broken on the COMEX, I don't care what the supply. There could be 0 ounces out there in physical terms, but the fact of the matter is the price is set in the paper market, nothing to do with supply and demand.
Could we run out of physical gold if there was suddenly a run and people wanted to have that hot little metal in their own precious hands?
Well, there's no question about it. We could run out of gold that people are prepared to part with. The fact of the matter is that if the price ever decides it's going to run seriously, there's going to be a lot of people that want to buy it, and there'll be certainly more people who want to sell it. But if the price becomes really, really ridiculous, then what you're going to see is that people are going to hold on for higher prices, and of course that'll just make the shortage even worse. There's no question that the physical supply pipeline for gold and silver in the retail business and in the commercial business area is long and very thin and very shallow, and any sudden spurt in demand would dry up the pipeline immediately, and we could see deliveries go to months. I've been involved in the retail bullion trade for many years. I know exactly how that works, and liquidity can disappear in a matter of days or weeks.
Would you suggest people buy gold coins or gold bars?
Gold coins or gold bars? Well, I'll tell you what, as long as they're 4.9's fine, it doesn't matter whether you buy gold coins or bars. Like, say, a gold maple leaf, you pay about a 1% premium to buy a gold coin versus a gold bar for whatever reason. But you get the money back when you sell it. So it doesn't make any difference whether you buy the coin or the bar, just as long as it's physical in hand.
Does the U.S. government really have a lot of gold on hand, or is it a myth?
Well, they like to say they got 8,000 plus tons in Fort Knox and West Point and the Denver Mint. And the fact of the matter is nobody knows whether that's the truth or not. And if they do have it, let's pretend for theoretical purposes that they do have all 8,000 tons. The other question is, of course, is its purity, and secondly, how much paper is written against. In other words, is there some sort of encumbrance on the gold that they do have sitting in their vaults? They owe it to somebody else. So it's a big question mark, and as everybody knows, there's been no audit of the Fort Knox since 60 years now almost. So nobody knows what the real story is, and if I had to guess, I would say that the real story is vastly different than what everybody can see today.
Did the previous Canadian government actually melt down gold coins that were worth a lot more than just their gold content?
Oh yeah, there was the Royal Canadian Mint's been sitting on the 1911 through 1913 $5 and $10 gold pieces that were minted. They've been sitting on bags and bags and bags, tons of that stuff for 100 years now. And what they did was they took 5 or 10,000 of each coin, the best they could find out of there, and melted down the rest. It's a travesty to see history disappear like that, but the reasons for holding on to it forever were not obvious. And although I, as a coin collector and as a bullion working in the bullion industry, I was kind of appalled by it, but I certainly understand it.
Did Canada and the UK make a mistake when they virtually got rid of all of their government-held gold?
Well, now that's a very long story, which I'm not going to get into here. My opinion is that Canada sold its gold at the behest of the United States in order to bring down the Soviet Union back in the early 1980s. That's the first thing, and the reason that England sold all its gold, in my opinion, from what others have said, is that in order to arrest the bullion banks from the Washington Accord that was signed, back in 1999 or whenever the heck it was, if the London Bank of England hadn't forked over a bunch of gold, a bunch of bullion houses would have gone down the drain, and that's one of the reasons they sold as much gold as they did. But the intrigue behind all that is, you could write a couple of books about it.
We'll have more with Ed Steer when This Week in Money returns.
Juan Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back to This Week in Money. We're speaking with Ed Steer. Ed, could gold and silver move higher alongside the U.S. dollar?
Oh, absolutely. There's no reason that they wouldn't. Remember, I just want to go back to what I said before. I want to make it absolutely crystal clear. What the currency markets, in a free market, the currencies would matter, okay? But we do not have free markets in either currencies, in equities, or in the precious metals. Precious metals prices are set in the COMEX. The price could be the dollar index could be going down, sideways, or up. and it only matters what the paper traders are doing in the futures market. So could we see the dollar index and gold rise together? Absolutely. And there's nothing stopping that except J.P. Morgan Chase. So the currencies and the precious metals are irrelevant. It's only what happens in the COMEX future market that matters. And I hope I'm making myself crystal clear about that. And Ted has been going on about this now for 20 or 30 years, and nothing has changed.
Are gold and silver stocks going to move higher alongside the Dow and the S&P 500?
Well, now, isn't that a good question? I mean, the precious metal equities have been going doing nothing but go down over the last week or so. So to say there's any kind of correlation between the two of them is a real stretch right now. I think how well the precious metals do will depend entirely upon what precious metals prices themselves do. And until precious metal prices are allowed to rise, we're going to see the silver equities languish. But are they the buy of the century right now? You betcha. And to anybody who's not invested and thinking about it, you couldn't pick a better time than now.
Why is that?
Well, like we just discussed right at the top, first question you asked me is, do you think we're at the bottom as far as the price goes for this move? And I'm saying, yes, we are. And if you're going to buy anything, you always buy when there's, as they say, blood running in the streets, and that's what we have right now. And if I was a buyer, I would be in there with both hands right now.
Are gold and silver stocks starting to attract attention?
Not at all. We're not seeing, there's not any interest in the gold stocks right now, but of course that could change on a dime if the price is allowed to rise. So right now, the precious metals market, the physical demand, which was stronger, a few months back, has almost completely dried up. And the precious metal prices are not being allowed to rise, even though the Commitment of Traders report is very, very, very bullish for both metals. That could change in a heartbeat. So precious metal stocks are going to languish until something changes with the price.
Going forward, do you like gold and silver major, mid-tier, or junior stocks?
I'm in the juniors. I think the largest producer I have is First Majestic, which I have a very decent position. But I have a lot of other companies like Fortuna and I'm trying to think of Great Panther, companies like that produce like 3, 4, 5, 6, 7 million ounces of silver a year. Those are the ones that are really going to fly when this thing goes. They're the most leveraged to the price. I have Pan American and Silver Standard Resources and Silver Wheaton as well. So I've got a mixture, but I would say most of my money's in the small to intermediate producers.
Do you prefer gold and silver ETFs or the actual bullion?
Actual bullion. Now, there's some people who agree with me, and Ted Butler's one of them. I know he buys the SLV and GLD, but that's for, trading purposes, I would think. If you're a long-term, if you're buying this for the first time, it's convenient to buy paper, but you're not helping the price any. Go out and buy the actual physical metal so you can hold it in hand. That's real gold. It's not paper gold, which is what an ETF is.
What's new with the Gold Antitrust Action Committee?
Well, I know that Bill and Chris are speaking at the New Orleans Investment Conference. I think it's early next month. I was asked if I wanted to go, and I said no. It's a day trip down there and a day trip back, and I really am not interested. And, Chris has his dispatches every day of what's going on in the precious metals market. And Bill and Chris and I all get interviewed either by radio by people such as yourself or on television or whatever, and we speak at the various conferences. So nothing's changed. The message is the same. The prices are still being managed, and until that changes, you're going to still hear Gada's voice crying out for things to change.
Why aren't regulators paying any attention to that?
Either because they're complicit or have been ordered to remain silent about it. There's lots of theories as to why they won't do anything. I think possible one is that they've been bought and paid for, or the other side of the coin is that some people think that this is a government-run price management scheme or by the banking system or whatever. So pick your poison as far as theories are concerned, but the fact of the matter is the CFTC will not and never will do anything about it.
Ed, can you tell us a little bit about Ed Steer Gold and Silver?
Oh, sure. Interested in my my service, I have a daily subscription-based service, edsteergoldsilver.com, where you can just Google my name, Ed Steer. And I write about 200-plus columns a year, and if you're interested, you could read the sample column I have on my homepage. And it costs $100 US per year for 200-plus columns. So if you like what you see on my homepage, you're free to sign up.
Ed, thank you so much for being on This Week in Money.
Thank you for having me out, Jim. See you next time.
My guest has been Ed Steer, founder of edsteergoldandsilver.com. And that wraps up the end of our show. We'd like to thank our guests, Ross Clark, Wolf Richter, Ed Steer, and thank you for listening. If you have any questions for the show or our guests, you can send them to info@howstreet.com. Now stand by for company showcase updates from American Manganese CEO Larry Reaugh and Grande Portage Resources President Ian Klassen. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with American Manganese President and CEO Larry Reaugh. Larry, I hear you're off to New Orleans.
That's right. New Orleans. I've been there to shows before, and I find it one of the better shows. So I'm looking forward to this one. It starts on the November the 1st and runs through till the 4th, and so we will be representing the company at a booth there, and we expect that we should be able to attract some investors. It's one of the spots that I got some of my biggest buying out of. Actually, it was a couple decades ago, but you never know. You never know going into these things. But we have a booth number 229, and we're looking forward to meeting some new shareholders, perhaps existing shareholders. And, it's a rough market. Sometimes you wonder if you'd had a little more foresight, which nobody does in these cases. You probably wouldn't have signed up for a show in the middle of a huge market correction. But it's done, so we got to go. We have to still discuss our company and explain our recycling opportunity. Well, that's where we're off to, and so another weekend burned, but hopefully it'll be fruitful. Now, there's other things that are happening out there. I saw some statistics where in the last 7 years there were 4 million EV cars, or actually, let's talk about the batteries, lithium-ion batteries, that went into cars, and they expect that in the next 6 months there will be 1 million. So that's how fast it's growing. Now, if people remember some of the things that we talked about, we showed the value of 100,000 lithium-ion car batteries. And the batteries were Formula 811, which is low in cobalt. But those 100,000 batteries still had a value of $340 million. I'm sorry, that was 111. And so it really begins to show up the opportunity that's here. We're talking about 100,000 batteries worth $340 million. As far as we know, nobody has a cradle-to-grave solution aside from us. And, it's a real opportunity for our shareholders, and sooner or later, people will realize that there is a real value in recycling these cars, not just a social conscience value, but environmental value, but a real monetary value in recycling cars, or recycling batteries. So I just want to remind people of that. I don't want to go too deeply into what the market's been doing. The markets will do what the markets do. But the this is certainly an October that is quite nerve-rattling. We see a lot of down days, and we see an odd up day, and like yesterday was an up day. I think all the other days this week have been down. So, these are things that people want. It makes people nervous. And but the reason I talk about the rapid growth in EV cars is that we're in a growth industry, and they're here to stay. They've reached a certain momentum that they're only going to increase, and the opportunities to recycle those batteries are increasing along with it. So, if you're looking for something that in the long term is probably go against the market, it's a company like this, like AMY, because we're, like I say, we're in a growth industry, and they can only see more and more batteries coming free, more and more batteries that have to be recycled. So the New Orleans conference is big on our list this week. I bring up the amount of cars that are being produced, and of course we saw that Tesla made their first huge profit, and that's a standalone electric vehicle company. So that one should be followed closely. It's a real breakthrough, and thank Elon Musk and Tesla for that. So it's finally you're getting a independent company out there that doesn't have a backup of fossil fuel cars out to boost up the existing profit and loss statement, and they're on their own. They live or die by EV cars, and they've done very well. And I expect to see increased and better results in the future. So there was because of the market, it's not a market where we can really talk about things. We just say that we are on track with our getting our pilot plant up. And, there's a couple of things that are on back order. I mentioned before that there's a lot of research went into how to actually dismantle a scrap material. And that's patentable. And, we've had to incorporate that into the design of the pilot plant, and which meant that we had to have new parts fabricated. So other than that, I wish everybody a great weekend, and we're off next on the 1st of November. We're off to New Orleans.
Larry, can you give us a little thumbnail sketch of the company?
Okay, the company is a critical metals company. We started out with manganese. We patented a breakthrough technology on processing very low-grade materials of manganese at comparative prices to the cost of China, and of processing, metals that were 10 to 20 times higher in value. And we've taken that process and we've adapted it to our patent-pending process for recycling batteries. And we're getting close. So, it's something that people should watch for. We're traded on the Toronto Venture Exchange, and under the symbol AMY. We're traded in the U.S. under the symbol AMYZF. We're traded in Frankfurt, Germany under the symbol 2AM. We can be reached, or you can read all about us and catch up on all the news. We have a very sophisticated website called AmericanManganeseInc.com. You can phone me at 778-574-4444, or you can email me at LREAUGH@AMYMN.com.
Larry, thank you so much for the update.
You're welcome.
We've been speaking with Larry Reaugh, President and CEO of American Manganese. I'm Jim Goddard. Our conversation took place on October 26th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. I'm speaking with Ian Klassen, President and CEO of Grande Portage Resources, online at grandeportage.com. Ian, welcome to Company Showcase.
Thanks very much, Jim. Good to be with you.
Ian, Grande Portage rolled out some news this week. Can you tell us about it?
Yeah, we sure did. We put out our first couple of drill holes that we drilled this summer in our program up at the Herbert Gold Project. We tested the deep trench vein, which has seen a lot of drilling historically, but we were very pleased with the results. We ended up using a different core size this go round for this particular platform. We used a larger core called PQ, which gives us a much better representative test for assay, as well as gives us an opportunity to do some metallurgical testing on it, which we had done and previously announced. But yeah, we ended up with a nice intercept of over 9 meters, grading almost 31 grams per ton gold, and just about 41 grams silver. So it was certainly a nice hole.
Ian, for people who are new to this show or new to your company, can you tell us about it?
Sure. The company's primary focus is 100% interest in the Herbert Gold property, which is located about 25 kilometers north of the city of Juneau, which is the capital city in Alaska. It is a host to 6 very promising gold-bearing mesothermal veins that have been traced along surface for anywhere from 2,900 to 3,300 feet each. We entered into the property in 2010 in a joint venture with Dr. Tom Patton and his company, and then ended up earning 100% interest in the property. We did drill test it in 2010, 11, and 12. Had some just fabulous results. This kind of a vein system pinches and swells, but it's very prolific and very predictable. While our overall grade is about 7.25 grams per ton, which is enviable for an underground operation. We have ended up with some spectacular bonanza grade, 15 meters of better than an ounce. So it's a prolific gold system, and we're happy to be working in Alaska.
Where is Grande Portage traded?
The company is traded on the TSXV. It's our principal trading platform. The symbol is GPG. In an effort to broaden our investor base, we did seek and secure a listing on the over-the-counter market in the United States. So we trade on the OTCQB under the symbol GPTRF. We also trade in Frankfurt for our European shareholders, and that symbol is GPB.
How can people find out more about Grande Portage?
They can hop onto our website and leave some information there that goes directly into our contact database, so that any news releases we send out, they'll get them live. Our website is www.grandeportage.com, or they can give me a holler at 604-899-0106.
Is there an email?
You bet. They can contact me directly, which my email is ian@grandeportage.com.
Ian, thank you so much for being on Company Showcase.
My pleasure, Jim. Have a great day.
My guest has been Ian Klassen, President and CEO of Grande Portage Resources, online at grandeportage.com. I'm Jim Goddard. Our conversation took place October 26th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at howstreet.com. Company Showcase is a production of Howe Street Media Incorporated.